Hey all, welcome to AlgoFox Academy. In today's video, we are going to discuss a very interesting topic, that is arbitrage. Now, a lot of retail traders who use our platform AlgoFox keep asking us, is arbitrage good for retail trader? And since AlgoFox has capabilities of executing arbitrage orders within few milliseconds, should I take arbitrage trade? Can I make that risk-free returns on my investment? To answer this, we will discuss a classic example of REC Ltd. This is a very good example to understand why arbitrage might not be the right choice for retail traders like you and me. So it all started yesterday, that is 29th of May. Today is 30th of May. In fact, I also tweeted about this difference in REC Ltd's spot price and future price. Today is the last Thursday of May and today is the expiry day. Those who understand spot and future pricing know that on the day of expiry, eventually spot price and future price will become zero. The risk-free rate of return in future price, that is the premium, will eventually become zero. If you're someone who does not understand what I'm trying to say, there is a detailed video tutorial on futures, its pricing and risk-free rate of return. Do check out. I'll attach the link in the description. The course is completely free of cost. Now coming back here, yesterday REC Limited had the difference between spot and future price of more than 2 rupees. In fact, let me directly take you to the chart. So this is the chart. On the chart, that is 29th May yesterday, look at on the one side, that is on the left side, I have future price. On the right side, I have spot price. Let me zoom in a little bit on the future price as well. And we will mark the closing price of spot and futures vis-a-vis. So you can see at 9:45, the close of future price was 583.40, whereas the close of spot price was 581.70. Moving on to next candle, 580.50, and it's here at 578.60. So around 2 rupees difference is constant. I can choose any candle, maybe let us say this candle where future price is at 577.25, whereas the spot price is at 575.50. So approximately 2 rupees, there were some cases where 2 rupees 40 paisa was also the difference between spot price and future price. Now, this is on 29th May, just one day prior to expiry. If I buy in equity and short in futures, I get that arbitrage opportunity. Let me explain you in detail on an Excel sheet. So on one side, we have REC Ltd spot, that is equity. And on other side, we have REC Ltd futures. Coming back to fires, at any given time, let us say maybe at 10:45, the price was 573.25. The closing price is 573.25 of futures. And for spot, it is 571.50. Now, look at the difference. Look at the premium. The premium is future price minus spot price. It is 1 rupee 75 paisa. Now, if I calculate it in terms of percentage, then the percentage premium will be 1.75 divided by future price, and we will multiply it by 100. So the percentage is 0.3% premium. This 0.3% premium is only when we have just 2 days left for the expiry. In a year, we have approximately 365 days. So if I have to calculate yearly premium yield, for 2 days it is 0.30. For 365 days, I will just multiply it by 180, right? So yearly premium would become 54.9, almost 55%. Now imagine REC trading at a yearly premium yield of 55%, whereas in India, the risk-free rate of return is hardly 7%. So this becomes a perfect arbitrage opportunity. But if I take this opportunity to make risk-free 0.3% return on my principal, is it worth it? Let us calculate and let us do some maths. Now, it's very simple. The lot size of REC Ltd is 2000 mentioned here, and to buy or short one lot, I need 3,20,000 rupees. So 3.2 lakh rupees is my investment, futures. And since the lot size is 2000, so in equity, I'll have to spend 11 lakh. So totally 14 lakh is what I'll have to spend. And in return, I will get the difference, that is 2 rupees approximately into 2000, that is 4,000 rupees as my returns. So I'm getting 4,000 rupees as my returns by investing 14 lakh. Now this 4,000 rupees is almost risk free. This is guaranteed return because you will be buying equity and you will be doing a short sell of futures. So eventually we have an assumption that at 3:30 p.m. today, that is today's expiry, the difference between spot and futures will eventually narrow down and become zero. So it does not matter if the market goes up or down, you will still make the difference. For example, if the market goes up, spot price will give you profits, future will give you loss, but when the difference narrows down, spot will give you more profits than the losses in the futures. Similarly, if the market goes down, spot will give you loss, future will give you profits, but since when the difference narrows down, futures will give you more profit than the losses in the spot. So irrespective of whether the market goes up or down, you're making 4,000 rupees. Now, let us do some more maths here. If 4,000 is my returns by investing 14 lakh, then the returns are 0.28%, the exactly same as almost the yearly premium of 0.3%. So in just 2 days, you're making 0.28% returns on your principal. But after taxes and brokerage, how much are you exactly going to make? This sounds a very fascinating or a very interesting trading opportunity. Just deposit 14 lakh. In 2 days, get 4,000 rupees on your 14 lakh. But if I go to a brokerage calculator, you can use any brokerage calculator, Zerodha brokerage calculator, Fire's brokerage calculator, or any brokerage calculator of your choice. I'll use Fire's brokerage calculator since I'm trading in Fire's. But note, we will not be taking care of we will not be accounting brokerage. We will be accounting the other taxes. So here it is. In equity, if I let us say buy at 570 and if I sell at 570 and if the quantity is 2000, the brokerage is 0. Fires is not charging me anything for delivery, for holding for a day. But the STT is huge, 2280, huge STT, right? So 2,542 is something that you give just to the government in this 4,000 rupees. So now in equity, you're losing 2,500 rupees approximately. To be very precise, 2,542.60 is what you're giving in equity to the government. And let us talk about futures. If I'm trading in FNO, price at 570, if I sell at 570, and if the quantity is 2000, that is the lot size, 281 is what the net charges are. Now in 281, I can remove 40 rupees brokerage that we are giving to the broker, 241 rupees, right? So 241 rupees is what we are paying in the form of taxes to the government. So overall, you would have paid 2,783 plus, even if you add some amount of brokerage, 2,800 rupees just in the form of government taxes. So your yield will drastically go down. Now your yield will no longer be this 4,000 divided by 1 lakh, 14 lakh into 100. It will rather be 1,200 because you made 4,000 rupees, but you're losing 2,800 rupees in the form of government taxes. So yield is now 0.08%. So even if I multiply it with 180 to get the yearly premium yield, it is just 15%. It is as good as any mutual fund investment. So if you ask me, should I do arbitrage opportunity as a retail trader? I would invest you do an SIP. That would give you better returns, because most of your profits is taken away in the form of STT when you're doing arbitrage where equity is involved. So if you're finding any other arbitrage opportunity where equity delivery is not involved, it would make more sense to capture that. But apart from that, if you're having an arbitrage opportunity in your mind where you have to have equity delivery also as a component of the arbitrage, I would strictly say no to it, right? Because you will deploy a server, you will deploy a data feed, you will deploy an execution, and you will take all the risk and will flat pay 2,800 rupees per lot approximately to the government. So there's no point of doing the arbitrage, right? Coming back, look at today's scenario. So yesterday, as I said, the difference was roughly 2 rupees. You can see at any given point here at 11:25, the close was 573.55. And here the in equity, it was 571.90. So difference was close to 2 rupees. Now, if we come today, since it's close to expiry, look at the difference. It is 564.25, 563.85 or 65, right? So difference is hardly 40 or 50 paisa. And as we approach close to 330, this 40 or 50 paisa difference will also narrow down to maybe 10 paisa or 5%, and we will be able to exit. But even if you spot such arbitrage opportunities, you need to do all of these calculations. And once you do all of these calculations, you will understand that the yearly premium that you get is 54%. But after paying taxes to the government, the yearly premium that you are left with is only 15%, right? So that is why I discourage retail traders to find any arbitrage opportunity and take the trade, because you do all the hard work, you take all the risk, and more than 50% of your arbitrage opportunity is given to the government. So SIP or mutual funds or investing in small golds or FD would give you better returns than finding such arbitrage opportunities currently in Indian market where equity trading is also involved. So I hope you have understood something, you have learned something new and interesting, and this will help you. I look forward to see you in another videos. Thank you so much.